Welcome to Proper Wealth with me, Paul Mahoney, the show where we discuss all things wealth creation, including property. Joining me today is Daniel Owen-Parr from Together. Welcome, Daniel. Let's start with a general chat about the topic of the episode. So the buy-to-let mortgage market from a lender's perspective. There's obviously been lots of changes recently.
Yep.
They seem to be being perceived in different ways by different people. How are lenders viewing the changes?
So at the moment in time in the marketplace, there's been a number of changes that have hit over the last couple of years. The market itself seems to be buoyant still. So there still seems to be a lot of activity going on. Buy-to-lets seem to be on the mind of a lot of individuals still. So I think there's opportunity in the market still, but I just think there's going to be a few changes over the next few years that may dampen it down slightly.
Okay. Yeah, so there does seem to be some mixed messages, doesn't there? And it's a little bit difficult, I think, for individuals at the moment to get a clear picture on what's happening. Perhaps we can touch on what each of the changes that have happened recently and how each of them are being perceived. So overall, I suppose we had Section 24 referring to the way that buy-to-let mortgage interest is being treated from a tax perspective. We had the stamp duty premium of 3% being introduced, change with regards to the way that lenders look at mortgage serviceability, and then also changes in regards to the way that lenders look at portfolio landlords. And then, of course, we have Brexit in the background as well. So quite a bit to consider at the moment. If we start with Section 24, how is that impacting the market at the moment? How are lenders looking at it?
I think with all those changes pretty much that you mentioned there, it affects the amount of money a landlord has got to service their debt and also the profit they make at the end of it. So I think with any change to taxation or with any change where they're going to restrict that amount of money they've got at the end of the month to pay either their lifestyle or that they need for paying the mortgage debt is going to cause some issues in the long run. So that one, to be fair, it's been here now for a couple of years. And I think if they've spoke to their accountant, looked through that and made sure they understand the full ramifications, because it's tapering now over a number of years, and I think the final date is the 2021 annual tax return, which will really have a full effect then when it goes down to basic rate tax. But as long as they're planning for that going forward, as long as that they understand their mortgage payments, then I shouldn't be too much of a problem now. Because it's been going for a couple of years.
I absolutely agree. I think it would be surprising how many people don't know how Section 24 is going to affect them. This is obviously the first year that it's started to be rolled into effect. So I suppose a lot of landlords will start to feel how it might affect them at the end of this year. And then more and more so over the next 4 years. But absolutely good guidance so far as them understanding how it will affect them once it's fully in effect. Okay. With regards to stamp duty, from a lender's perspective, does that affect things at all?
It will, once again, it will really affect the individual's cash flow, and that's the important to understand that. And it's not quite simply just 3%. It's worked on a tiered basis, so you've got to be careful. You just think it's just 3%. The more expensive the property is, so for instance, if you were to purchase something around £275,000, it's not just 3% of 275,000. It tiers on a number of levels up to 1.5 million. So you'd be paying around £12,000 in stamp duty for that second property, or if it's in a company name, the first property you put in a company name. So you've really got to understand your cash flow from day one, that can you afford this stamp duty, which wasn't there a couple of years back. So when you were purchasing, have you got enough to afford the deposit? Where now you've got to take into fact, you've got the deposit, you've got the legal costs, and then you've got the stamp duty going on top of that. So growing a portfolio now will be slightly more expensive than it was prior to this.
Yeah. Okay, so obviously touched on Section 24 affecting serviceability essentially there, your yield being more important, the stamp duty affecting your initial capital costs, and then I suppose that affects what value properties you're buying. Another one we mentioned was mortgage serviceability overall, so the way that lenders are viewing that. I suppose they all kind of tie into each other a little bit, don't they?
Yeah, very much.
And there does seem to be a trend with all of these changes, more so affecting higher value, lower yield properties. Do you have any views on how that's going to affect sort of the country geographically?
Well, so if you think of somewhere like the southeast, London, into the home counties, what you see there is normally higher cost properties with slightly lower yields, and that will affect it because the return that you're getting on your property on a monthly or annual basis will be reduced significantly if you have to then take into consideration the Section 24 changes, serviceability around how much you can afford on a loan. So the regulations have changed now that it's quite standard across the whole industry. So the potential authority has come in there and set out some fairly stringent guidelines around 125% of the rental yield to lend at, and they also stress testing that comes in with it as well. So you'd have to be careful that the lender would probably restrict the amount they would lend on that property. So you would probably have a much lower LTV or loan to value in something like that.
So making it more difficult to borrow what you previously would have been able to borrow in those sorts of locations. I think that's quite interesting. And I suppose potentially the shift that could cause, when you look at the fact that London historically has been the safe haven,
Yes.
you know, not just of the UK, but almost the world, you know, the financial centre. And now it's becoming more and more difficult to actually justify a buy-to-let purchase in that sort of market. I suppose that has to benefit other areas in some way because people are still buying.
Yeah, very, very much so. And you'll see around the country that where London was the centre of everything, now people are moving out and they're looking for areas where they're going to get a better yield. So, for instance, somewhere like the northeast, Humber area, Liverpool, where they've got lower cost properties, but they're getting a much higher yield, they are now becoming slight hotspots. Across the north of England, Birmingham, they're seeing more and more landlords moving from the London area out to these areas, and also people moving out of these standard terraced housing or three-bedroom semis, moving into HMO type properties, student lets, holiday lets, looking, you know, Airbnb for instance. Landlords who are moving from the standard tenancies into Airbnb, where they'll get a higher yield off the back of it. So it is changing the market, these changes now.
Yeah, that's another shift, isn't it? It's trying to avoid that Section 24 change going into commercial property as opposed to residential. Or, as you say, trying to boost their yields a bit to deal with it. It's quite interesting. Another trend that seems to be happening at the moment is not just the shift in sort of buyer demand, but also the shift in where people want to live in the UK. You mentioned places like the northeast, the northwest. Someone ran me through an interesting example the other day, so far as a young professional trying to buy in London, and it's very difficult. That same young professional would go up to somewhere like Manchester or Liverpool and buy a city centre penthouse apartment for 400 grand. You can't buy anything in London for 400 grand, so it kind of makes sense as to why that person might move to a location like that. We mentioned Brexit briefly. Do you or lenders in general have any view on the impact that's having or what the impact it might have?
I think at the moment in time it's the uncertainty that's the issue. I think for any lender, anybody in business, any landlord, you want a certainty of regulation, of taxation, and where the government's going to be going. So at the moment in time, with the uncertainty, this is affecting purchasing decisions. So am I going to invest in property or am I going to keep my money theoretically under the mattress to a certain degree? So what we would like is consistency from the government. We'd like them to come out and set out the stall about what will happen after the D-Day, when we leave sort of March next year. We'd really like to know what that would be and how that would be painted. So I think for landlords, I would expect some of them would take the decision to rather keep the cash for now and see what happens after March next year. So we may see a slowing down in the marketplace.
It's all very much speculation at the moment. No one actually knows what Brexit is, do they?
No, and that's the difficulty.
And I think it's also interesting that probably based upon political views, some people are viewing it as a real positive, whereas other people are viewing it as a real concern. So I agree, it will be really interesting to find out what Brexit is when it actually comes about. One thing we didn't cover so far as the changes was portfolio landlords. How are those changes affecting things?
So that's been coming to the market now for a little while. So basically anybody that's got 4 properties or more is now classed as a portfolio landlord, and you've got to treat that slightly differently, and quite rightly as well. We don't want to go back to the pre-sort of 2008 issues we had with landlords. So at the moment in time now, rather than just looking at an individual property in its own right, you'd want to be looking at the overall portfolio and the affordability across the portfolio. You'd want to be looking at the experience of the individual. You'd want to be looking at making sure that they can afford it now, but also can afford it in the future as well. So I think there's a number of changes that come in that are right for the industry, but it'll take a little bit of time because a number of portfolio landlords will be rolling off sort of long-term deals now, which were done sort of pre-2008 and onwards into a new regime now, and they may find the number of lenders that will be able to offer them a loan decreasing, so there'll be a little bit more opportunity out there for the specialist lending market to come in and sort of have a look at these portfolios.
Look, I absolutely agree about it making sense. I think with everything that landlords have been hit with lately, any changes are easily perceived as negative ones, but I don't think anyone logically can agree that it makes sense to look at your whole portfolio when lending as opposed to just one property, because that one could be great and your others could be terrible.
Yeah, correct.
And it certainly seems that so long as landlords do have portfolios that work, then they shouldn't really be too negatively affected by that change. It's just a bit more information they need to provide.
Yes, I think it's a lot of these changes also are professionalising the industry, and that's one of them. So simple things like keeping a portfolio schedule to understand some very basic information around the value of the property, when it was last valued, what the rents that are coming in each month, and as long as you keep something up to date on that, most lenders will be quite happy to look at that. But the number of lenders out there will probably be slightly less than they were previously. They'll be looking on portfolios.
Sadly, that's all we've got time for in this part of the show, but don't go away because we'll be back. Welcome back to Proper Wealth with me, Paul Mahoney. Joining me again is Daniel Owen-Parr. So Daniel, we spoke before the break a lot about the changes in the market and how they're being perceived by both landlords and lenders.
Yeah.
Perhaps we can recap on that a little bit and talk about some of the challenges, but also the opportunities in the current buy-to-let market. So if we start with the challenges, we spoke about some challenges around yields and also property values. How are you perceiving them sort of impacting the market?
Well, I think at the moment in time with Section 24, with the stamp duty changes, it restricts the landlord's ability for large deposits, or their yield that they're receiving that may be used to pay their mortgage payments might be slightly less. So it's for the landlord to really look at what they're receiving in and making sure that it's affordable going forward. So I think it's there for landlords to maybe speak to their accountants and really work out and understand their portfolio now with these changes.
So I suppose one of the challenges is the requirement for professional advice that perhaps wasn't as much of a requirement previously.
I think it's best advice as a lender. We would want people to be speaking to their accountant and getting that really professional, proper advice to understand how these changes will affect them in a personal way.
Yeah, okay. So accountants, mortgage brokers, property professionals, there's a range of different services out there, isn't there? Okay, so that's some of the challenges. Now on to the fun stuff, the opportunities.
Yeah.
So what would you say are some of the opportunities in the current market?
I think the opportunities sit there very firmly for entrepreneurial landlords. There's a lot of property out there at the moment in time, and there's a real supply issue around the standard stuff, which are your terraces and your 3-bedroom semis, but around some more creative landlords, you can look at maybe converting former commercial or semi-commercial buildings, looking at former commercial properties that have never had any use relating to residential. So something as interesting as a former toilet or something like that could be converted into residential, or looking at what property they currently have where they can extend or maybe even go into a little bit of development themselves and actually create property. So I think there's a lot of opportunity around looking at different sides at the moment in time, not just your standard 2 up, 2 downs or 3-bedroom semi.
There is a lot of talk around the professionalisation of the industry, isn't there? And I suppose landlords looking for different ways of dealing with these changes, whether that be higher yielding, lower value residential areas, moving into commercial spaces, you say, perhaps getting a bit more creative with development. I'm not sure about living in an ex-toilet, but there's a whole range of things happening, isn't there?
Yeah.
I suppose another interesting thing is the broad range of lenders out there and how they approach the market, how they view the market. So if we could talk about the difference between high street lenders and more specialist lenders and the spectrum in between.
Yes, so we can talk sort of a pre sort of 2008, and the main lending was done by your clearing banks. So your main lenders out there that you'll see on every high street in the UK were probably predominant of the market. But over 2008 and onwards, there's been a rise in the specialist market. So you're looking at short-term lenders, challenger banks that have come into the market, peer-to-peer lending, private lenders. So the market has grown dramatically over that period of time, with a number of lenders coming into that space who will offer different products or different solutions to clients now. So the likelihood of them going to the bank as the first point of call is less likely nowadays.
Okay, and I suppose that's another opportunity, isn't it? All these different types of lenders that didn't exist not so long ago, offering more solutions.
Yeah, I think in one way there's a lot more solutions out there in the market, but for individuals who are not au fait with the market, they're going to have to get advice because there's so many different lenders and varying different ways that they will look to raise capital for clients to help them fund their buy-to-let. So. Yeah. Taking advice, once again, we spoke before about your accountants, your mortgage brokers, people like that. That's where you'd need to get some advice.
Well, I suppose it's very difficult as any individual, regardless of the level of experience or knowledge, to have such a broad scope of understanding of what's available. So I suppose that's where professionals come in handy, isn't it?
Yeah, very much.
Is giving that resource and that knowledge.
Yeah.
Okay, so some of the things that are new in the market. We spoke about some changes. One of the changes we didn't cover, one of the most recent ones being with regards to EPC requirements. How are lenders viewing that?
So that's come to us very recently. So from the 1st of April, the regulations changed about what can be used as a buy-to-let property. So if you've seen a valuation recently, you will have seen on the back of it an EPC rating starting from A all the way through to G. The new regulations dictate that anything that's E to A can be rented out as normal. F and G you can't rent out. So there's a lot of opportunity in there for people to pick up buy-to-let properties, do some work on them, turn them into a property that can go onto the market. But you need to make sure that you understand that as a landlord, because you can be fined by your local council, or in the worst cases, you can actually be banned from renting property out. So really important that you understand where your property is and if it needs any work doing to it. And that's where a good surveyor would be able to talk you through that and how much you need.
I found it quite interesting that lenders are actually now have to actually review that. I think in the past, a lot of people probably found it quite easy to sort of get away from the council and get away with those sorts of things. But then when it comes to get a mortgage, if you don't have the ability to prove that you're meeting those requirements, well, you're not going to get one, are you?
No, not at all.
So that gives you more reason to make sure that you're aware of those sorts of things, which is obviously very important.
Yes.
Another trend in the market seems to be the permitted development rights, conversions of office to residential or commercial to residential property. Again, there seems to be a mixed view on that from both a sort of buyer's and a lender's perspective. Do you have any views on the PDR and how that's impacting the market?
There's been a real growth in that over the last few years. The government changed the regulations a number of years back, but it's taken a little bit of time for that to grow. As a lender, you'd really be making sure that an individual purchasing a larger commercial building to convert would have the experience to do that, or has done some development, because it can normally take a fairly large project to turn the commercial building into a residential, and a number of factors you need to take into consideration. So we talked earlier on about bringing the professionals in. So in this circumstances, you'd really be looking to have a team of very experienced individuals, architects, planning, to make sure they understand how much it's going to cost to convert that across. And then as an individual purchasing out of a PDL project, most lenders will look at a property a larger property, maybe a block of flats, as a concentration risk, so making sure that they're not overexposed in one area, so we haven't got too many units charged to them. So things to be taken into consideration when doing PDR.
Okay. All right, so obviously from the development side of things, just recapping what you said there, lenders looking at the experience of the overall team to make sure they can actually deliver. I suppose that's probably something that's quite important for the end buyer to be looking at as well.
Yes.
Especially if they're buying off plan or something like that, which obviously is happening quite a lot at the moment. These buildings are bought, sold off plan in the right circumstances, that seems to work quite well. Obviously in the wrong circumstances it can work quite badly.
Yes.
So everybody involved needs to be confident that it's going to the right outcome. And then that's interesting from the buyer's perspective, the way lenders are looking at that. I suppose lenders are always looking at limiting their risk, aren't they,
yes.
On a certain building. Would you say, is that also partly dependent on where the buildings are and where lenders see sort of the demand for those properties?
I think that you get certain areas where there's a very high concentration of conversions or blocks of flats, then a lender would look at that to make sure there is the demand to meet that supply. At the moment in time, we've got an undersupply in the UK, so there's not too many areas with that issue. But it's something to take into consideration. There's a number of projects all going on in one area. You just want to make sure that the lender will want to be in that market and there's demand for that.
I suppose that's the reason for these permitted development rights changes, and to increase the supply of residential property in the UK. So overall, that certainly seems to be quite a positive thing, quite a positive trend. But certainly quite a few things to consider there.
Yes, with anything when you're dealing with property, it's always do your research. I think that's the major thing to do there, and use your professionals and make sure that it's somewhere that you want to live and you can commute with good bus, train routes to where you work.
Yeah, okay. Do you have any examples of where you've seen permitted development rights or the sort of conversions work really well?
Well, we've seen, there's a number of these around the country, and that could be anything from turning old, redundant warehousing into student lets, or it could be straight into something that's a residential flats. So I think there's a number of them around the country, and if you think of any sort of city centre hotspot, could be central London, around the Canary Wharf area, all the way up to Newcastle, Edinburgh, places like that. So I think it's good that we can take redundant properties in most cases, or quite tired properties, and turn them into something new that can be used for a number of generations to go. Yeah,
and some of them can be really highly desirable properties, can't they? Especially those old sort of grade 2 listed warehouses. They can end up being really cool places to live. I've seen some of those being done really well.
Yes, definitely.
Sadly, that's all we've got time for today. Join me again. I'm Paul Mahoney, and this is Proper Wealth.